All right, so I figured we'd do something a little bit different today and take a break from the flows and talk about liquids pipeline rate making. So I know that's kind of boring to most people, so I'll try to make it quick and try to gloss over the stuff that's not really important. The reason I'm doing this is the liquids tariff index gets re-looked at by FERC every 5 years. So they're going to review that every 5 years. They do a review of that, and there's potentially some interesting things that are going to potentially happen with that. So let's dive in. We'll do this via just a slide share here. Bear with me a minute. Okay, so it's probably good to start off with just to talk about the different types of tariff and tariff rate making with liquids pipelines, and just to level set, when a liquids pipeline comes online, they have to do an initial rate filing. They can either say, here's a cost of service filing where we outline how much our return is going to be on our pipeline, or they can provide a sworn affidavit that at least one unaffiliated shipper has agreed to the rate to the rate that they're proposing on this pipeline. So from FERC's point of view, this is like a negotiated rate. FERC says, hey, if somebody unaffiliated with your company is willing to pay that, then we view that rate as being just and reasonable, and we will let you charge that rate. After the initial rate, there's a few options of types of rates, types of rate making or rate structure that you can have on your liquids pipeline. The first is the most common, and it's the one we'll talk about today. It's index rates. So basically, FERC has decided to make things simple. Once you do your initial rate filing, after that you can increase your rates by an inflation factor over time. So your ceiling rates, or the highest rate you can charge, can be increased over time based on an inflation factor, and we'll talk about that inflation factor here shortly. There could be settlement rates. You don't see this too often, but there's definitely some pipelines that have it. That's basically like, hey, all the shippers on the pipeline have agreed to this rate, so we should be able to charge whatever we want. FERC says that's fine, so that's settlement rates. Market-based rates, you see this more now. This requires a application to the FERC, where if you can justify that your pipeline has lacks market power at the origin market and the destination market, you can essentially charge whatever you want if FERC gives you that market-based rate approval. So it's a long review process, but several pipelines have done that over the last, let's call it 5 to 10 years. Not too common, but it's somewhat common for sure. Cost of service rates is probably the least common on the liquid side. Basically, a pipeline can propose to FERC and say to FERC, hey, using this index won't work for us. We're just not recovering our cost of service. And there's a substantial divergence between what we can recover with this index rate and our cost of service. So we should be able to do a cost of service and raise our rates that way. So again, sticking with the index rates, because this is what we're focusing on today. It's most of the pipelines have index rates. I'd say close to 80% of the pipelines do some sort of indexed rate adjustment on their pipeline. Not all of those are always at the ceiling. Sometimes the pipe is below, the rates are below the ceiling, so the ceiling just gets raised. The rates don't necessarily get raised. But we'll talk about on the next slide how FERC actually decides what increase on the index rate should be. So they utilize what's called the CON methodology to decide what the rate increases will be. It's reviewed every 5 years. We're due for a review right now. I'm surprised it hasn't come out yet, probably because the previous rate issue is still being talked about. We'll get into that. And it basically calculates each pipeline's cost on a per barrel mile basis over the previous 5 years. So FERC looks at the financials of all these pipelines and says, hey, what actual cost increases, percent inflation factor of cost increases did we see over your pipeline over the previous 5 years? They remove outliers and spurious data by trimming the data set. So they'll remove an equal number of pipelines from the top for the highest inflation pipelines and an equal number of pipelines from the lowest inflation of pipelines, and then use that middle or that trim data set to do their analysis. They average the mean, median, and weighted mean to determine the composite central tendency. So the composite central tendency is compared to a PPI figure. So PPI of FG is producer price index of finished goods. That's a Bureau of Labor Statistics inflation factor, and basically they're going to look at their analysis and say, hey, our pipelines, and I'll get to this in the next slide, or this next bullet, we might as well just bring it up. So let's just use an example. If the calculated composite of central tendency, or the inflation factor or cost change that FERC has seen on the pipelines over the past 5 years is, let's say, 2% in this example, and PPI-FG during the same period is 3%, the FERC adjustment over the next period will be set at PPI-FG minus 1%. So basically just tying it to that PPI-FG and then adjusting it based on what they've seen the pipes inflate or deflate compared to that number in the past. So I think it's interesting. Not interesting. Let's say it's imperative, if we're going to talk about the upcoming review of the FERC index, to talk about the issues that they've had with the 2020 index. So the big one, and the one we'll talk about here today, is the data set trimming, whether to use the middle 50% of pipelines or to use the middle 80% of pipelines. It was a big issue in 2020. It's probably going to be a big issue for this one. So we'll talk about that a lot. There was also a couple other issues. These will be not relevant in my view for 2025. So there's an income tax allowance we won't go too much into this, but removing the effects of the income tax allowance or not removing it, and then the use of revised year's filings, which I think FERC's on board with, so I don't think that will be an issue in 2025. So again, to talk about what's going to happen in 2025, I do think it's important to talk about what happened with the 2020 review. So I have a timeline set up here, and we'll go over what really happened. So when FERC first does their review, they put out like an initial proposal and said, hey, we've done the analysis, and that's what you see here in mid-2020. We've done the analysis, and based on our numbers, the producer price index of finished goods, the inflation adjustment based on the cost inflation on the pipelines that we see, says that the adjustment going forward should be PPI of finished goods plus 0.09%. So basically right on par with the PPI of finished goods would be what the increase would be going forward. During this time period, let's call it 5 months here, pipelines are allowed to lobby FERC via writing and be like, hey, we should use different numbers, or the shippers can lobby FERC and be via writing and be like, hey, your analysis should include this. So you get to hear from both sides on what they think should actually happen. And I'll go back here. One of the big issues was, are we going to trim the data set from the middle 50% to the middle 80% or not? So in the initial notice of inquiry, FERC used that middle 50%, but the pipelines lobbied and basically wrote and said, hey, you should use the middle 80%. It's a more robust figure, is basically what their argument was. And FERC came out and they agreed, among other things like the income tax adjustment and the revised filings. FERC agreed with the pipelines and said we should use that 80% figure. But the effect of that, using that 80% figure, was to actually boost the inflation factor. So FERC ordered and said, we agree with the pipelines here. This is what it'll be going forward for the next 5 years. Well, as you can imagine, the shippers probably weren't very happy with that, because that means they're paying more money in the future. So they requested a rehearing and basically protested and said, this is wrong. You should use this for these other reasons. Well, FERC, and we'll just back up a minute. I would note here, and we may get into this later, that there was a regime change here. So we had an administration, the first Trump administration ended at the end of 2020, right about when this was put out. And then we had a Biden administration came in. So we have new FERC commissioners that are deciding between this point here and this point here. And what the new FERC commissioners did, which would be more Democrats than Republicans, on the seat. There's 5 seats on FERC. Three will be one party, 2 will be the other. And when when an administration changes, typically you see those seats flip between Republicans and Democrats depending on who's in power. So the democratically controlled commission said no, in like a year and a half later said no, we erred in setting it at this. We shouldn't allow the income tax adjustments. We shouldn't use the 80%. We should use the 50%. So we're resetting it back to a new number, which they recalculated again at PPI of finished goods minus 0.21%. So you have about a 1% difference each year going between these two numbers. Obviously, the pipes were upset with this. They actually filed in federal court here and said, hey, they already made this rule. They made this rule here without giving us any comment period, allowing us to make our case. And that was one of their arguments, was the FERC had set the order already. To change the order, you have to actually give us time to comment on what you're going to do and plead our case of why you shouldn't do that. So we had a long period where this was tied up in district court. And LEPA versus FERC was decided in, let's call it mid to late 2024. And the courts said, shippers, you're right. Or, sorry, not shippers. Pipelines, you are correct. If the FERC is going to make a change like this, they have to put it out for a comment period and hear people out. Because they didn't do that, you have to revert everything back to this original order. So instead of having the index inflation adjustments each year be this lower figure, you have this higher figure that got reinstated, and everything got backdated to this higher figure. So that's where we stated. This is still ongoing. So like a month after that, FERC did put out something that reinstated the index at 0.78. The shippers did request a rehearing on this, and FERC did put out a new notice of proposed rulemaking, say, okay, we messed up before, we're doing the comment period now, we're going to try to change it to PPI finished goods minus this lower number of minus 0.21%. So I would note that any change, based on the wording that I see that FERC puts out there, now this could be challenged in federal court, but it doesn't appear that even if they make this change, they haven't yet, they've just put it out as a proposal. Even if they make this change, it's just perspective. It's not going to be retroactive. It's not going to change the rates back in time. It's not going to reset the base rates. So it'll just be, hey, for this year, for this 2025 year, you need to reset your rates to this minus 0.21. But nothing back in time changes based on my reading. Again, this could be challenged in federal court and that could change, but that's my reading of the situation here. So we are still without a decision or without certainty on what the actual 2020 pipeline increase was. Now, it can't be changed back in time, but again, hopefully you see the importance of the inflation adjustment here. It certainly can change, due to compounding, can change the rates pretty significantly over time. So we'll look at this and just to see what the actual pipelines argued. So when FERC decided to do their 50% trim justification, they said, hey, look at these these annual cost changes, compound annual rates. If you look at these pipelines, if you look at using the middle 80%, you get these outliers here that weight the sample quite a bit to the upside. So that's why the FERC changed their minds, and the shippers actually came up with a graph that was very similar to this, that proposed this and said, hey, this is outlying data. You shouldn't use these pipelines for whatever reason, because they appear to be outlying or spurious data. Now, in the argument that the pipelines have made back and is still being looked at by the FERC, they say, hey, why don't we look at the whole data set? Instead of looking at just the middle 80%, this is the whole data set. And if we use the whole data set, this red piece here, which is the 8 pipelines that lie here on the shipper's graph, they don't look so bad. They don't look that out of the ordinary compared to the rest. So this is the back and forth between the two groups, and this is going to have implications for the 2025 reset of what it'll be for the next 5 years. The big question is, are they going to continue to is the FERC going to continue to use this middle 50%, or are they going to flip again and change their mind again and say, okay, pipelines, you're right, the 80% is justified? I would note again, we have 2 new FERC commissioners coming in probably in the next month or two, that will flip the seats to be from where it's today. There's only three commissioners on the FERC right now. I believe it's 2 Democrats and 1 Republican. That will change to 3 Republicans and 2 Democrats. So that could change the voting on and how they decide to do this. Again, I don't know if it will, but it certainly could. Okay, so let's get into the meat of the analysis that I've done. I've taken the FERC data. I've taken the FERC data from the last 5 years, all the cost data for all the pipelines, and cleaned it to the best of my ability, adjusted for some M&A on some obvious M&A on some pipelines, and did my own analysis, very similar to the work papers that the FERC puts out for the analysis that they do when they calculate what the inflation adjustment or the index adjustment should be for the next 5 years. So this is my analysis based on the previous 5 years of data on what we'll look at, and we'll look at the middle 50% in case they trim to the middle 50% going forward, or the middle 80%. So I've looked at both scenarios. I would note the data here is really dirty. The numbers that I come up with are certainly going to be different than the FERC's. The FERC will clean their data a little bit differently. They'll do M&A a little bit differently. But when we're talking about cutting out large percent or trimming the data set quite a bit, I don't think my numbers will be wildly off from what the FERC ends up with. So I imagine that some of the pipelines that listen to this, or some of the shippers that listen to this or watch this video, will have done this analysis already. If my numbers look significantly different from yours, please reach out. I can share my work papers with you, and we can look at that. But the sample size here is, I think it's 191 pipes is what I have after I clean all the pipes, and then cut out the ones that don't have good data, where it's incomplete data. You certainly have that for a large chunk of the pipelines. It's about 191 pipes, and then we're cutting the middle 50, we're cutting the top 25 and bottom 25% for this middle 50% analysis, and the top 10 and bottom 10% of this analysis. I guess what you see here is, for the first time that I can remember, you have a pretty significant deflator versus PPI of finished goods. So as I'm sure most of you know, we had quite a bit of inflation over the last 5 years. So PPI of finished goods came in at around 4.6%. My cost analysis using this middle 50% trim data set shows the pipes only saw inflation of around 3%. So the difference between the two is going to be what FERC would theoretically set the inflation adjustment at. So PPI of finished goods minus 1.55% would be theoretically, in this theoretical situation, what it would be. So as long as you have PPI of above 1.55%, you're not seeing decreases on the pipelines. But you would need PPI of finished goods over the next 5 years, each year, to come in over that number to get any increases on the ceiling rate of the tariffs on the pipelines. I did the same analysis with the 80%, the middle 80%. As you can see, this is better for the pipelines. You do include some of the costs on some of those higher inflation pipelines, so that's why you see this larger number here, but still not great. I mean, I remind you, the last 5 years we were at PPI of finished goods plus 0.78%. This is minus 1 and 1.5 and 1%. So it's not great for the next 5 years for liquids pipelines based on my analysis. So yeah, so this, and we'll get into the next slide of why this is kind of a big deal. So let's take a look at, I'll just bring all this up, just a couple scenarios where we look at different scenarios if you trim the data differently. So in this example, scenario 1 is what I would say is the most bullish scenario, where we trim the data to the middle 80%. So we'll use what FERC had for 2021 to 2025, which was 0.78%, and then the actual PPI finished goods increased over those time. And then through 2006 to 2020, I just used 2.5% of PPI finished goods minus my more bullish, still a negative figure here, and then compare it to what I would say is a bearish situation. So if FERC got what they tried to change the PPI finished goods to, the negative 0.21 back in 2022, if that was the number for the entire time period over the last 5 years, versus my middle 50% number here. And you can see the difference in revenue depending on what FERC actually would trim that data set to in this theoretical analysis. And it may not look like a lot on this graph. You see a difference, and because of compounding, this gets bigger over time. But this is a pipeline in this example. It's 300,000 barrels a day. It's $2.50 tariff rates. You're talking about $3.7 billion, $3.75 billion versus $3.6 billion over the 10-year period, and a difference of $154 million, or 4.3% of total cumulative revenue over that 10-year period. So again, I think people who look at this from a financial standpoint view it as kind of a rounding error, and that's true on a year-to-year basis. It's not that big of a deal. But the actual 1% differences compound quite a bit over time, and it is a big deal. So even a pipeline like this is just, let's call it a medium-sized pipeline, 300,000 barrels a day, $2.50 rates. You have $154 million of difference over that 10-year period. Imagine a company like Plains or Enbridge, who has tons of pipelines, way bigger than this, that are moving tons of barrels. Like these numbers get huge. So now you know why these companies probably have compliance teams or regulatory teams and lawyers helping them to try to get the most possible out of these tariff rates. So hopefully that gives you a better understanding of what liquids pipeline rate making is, and the options there, and certainly not the brightest picture for the increases going forward over the next 5 years, based on my analysis. So yeah, I hope everyone enjoyed the video. Feel free to email me with any questions. If you want to look at my working papers, feel free to email me. Yeah, thanks. Have a great day.